Well, good morning. Oh my gosh. So I had an agent come up to me yesterday and say, so are we going to every other week with these things? And we're not. So it just so happened that I know Megan was unable to be with us last Thursday. And I wasn't going to be able to be here this Thursday, but we ended up being able to carve it out. I'm in a hotel room in Las Vegas. And if you guys know me at all, you know I hate Las Vegas. It might literally be the very last place on my list. But I'm here. And so giving a presentation here in a couple of hours to almost 1,000 loan officers, super excited about the keynote this afternoon. But in the meantime, goodness gracious, great balls of fire. There's a lot that's been going on. And I know Megan is excited to share how the real estate market has been moving. I know you guys need to hear how it's been moving because you've been trying to figure out how to price your listings and what to communicate with your buyers and your sellers. I'm going to talk a little bit about what happened last week and then what's happening this week, because this was supposed to be a quiet week, but that didn't happen. So we're going to talk about all those things and more. Here's our quote. Because, you know, sometimes you feel like you're a little bit on the edge and you don't want to speak up, but I'm going to tell you, this is the year to be bold. So here's my quote. The next time you're afraid to share a crazy idea, remember that someone once said in a meeting full of people, hey, let's make a movie about a tornado full of sharks. And it worked. There were 6 of them. Sharknado is actually a movie, and I was a little surprised by that. Hey, there is no such thing as a crazy idea. And in this market requires all kinds of crazy and creative ideas. Megan, would you agree?
Yes, it does. I'm certainly having to go outside the box and posting more, getting out there more, giving more presentations, and it's just all about doing more this year in order to get more transactions under my belt. I haven't worked this hard in about 14 years since I first got into the industry, but I am doing everything I can to make up for the difference this year.
I don't know. You work pretty hard.
I worked pretty hard. This week I was up at 2 one morning this week getting work done to get the reports out. I was up at 4 yesterday. I got up at 3:30 today because I couldn't sleep. So I was like, well, I'll just go and work. And so it's been doing everything I can to keep the wheels on the bus.
Oh my gosh. Oh my gosh. Well, I know that we're working hard. I know that we've got a ton to talk about. Are you doing the May monthly update as well as the last week?
Yeah, I'm going to head on both. So I've got the May update already done for you, and that was sent out to you on Tuesday afternoon. So you guys should already have a copy of that. I'm going to go over some of the highlights that we saw in May. And then I'm going to hop in and I'm just going to do the first portion of the weekly update, but make sure that I send that out to all of you so that if you wanted to look at it broken out by price range, you've got that all that information broken out by price range for each one of your different areas. And my landscapers are coming through. Can you hear that?
Oh no. And I know you're sitting outside because you got bathroom work.
I know. And I've got demo going on in my house right now. Tell a joke, Nicole. I'm going to move inside.
Okay, sounds good. You guys know I have no jokes, but I will tell you one of the things that I'm going to talk about the second half, and only because I'm making up time, so I'll talk about it now. Guys, the mortgage industry volume is down. You're feeling it. The real estate industry is down, but you have cash buyers. So that means that you've got to get all of your prospects to opt out. Because the moment a lender pulls credit, that information can be shared legally, your public information. So you want to make sure. I've been advertising a lot. We've been talking about it a lot on Market Trends. We're going to be putting it out on social again this afternoon on how to opt out. You guys push that forward as well. Nobody likes to get 50 phone calls from other lenders who are scrambling because they have no business. It is a crazy market. So we're going to talk about that in the second half, but Megan, I got no jokes. So I just
no jokes. I know I always put you on the spot with that one. It never works out. So I'll just have to be like, Nicole, do you have an interesting fact that you can share with our audience right now?
Facts.
Yes. So let's go ahead and hop into it. And I'm going to start out with the monthly report first and go over what happened in the month of May. And so this is for detached single family. Keep in mind that there is a sister report for this that is also for attached. Sorry, my thing is stuck in the way. my bar is stuck right where I need to share my slideshow. Okay, there we go. Can you see my screen?
I can. Just the
Perfect.
presentation one's perfect.
Yep, just the presentation one. Awesome. So this is for May. This is for detached single family. There is a sister report that's attached single family, and it is the same page by page. Now you'll notice I've switched up the way that I send out my emails to you guys, where I used to give you the market update embedded within the email and then the option to download the report below the email. Well, my emails started turning into these really long, drawn out emails. And so what I've decided to do is to put the top 5 talking points, top 5 to 7 talking points on slide 2 of your report now. So if you're looking for those talking points or those bullet points that you need in order to get information out there for social media posts, or if you need cocktail chattable quotes, something to say at a cocktail party, you've got that on page 2 of this report. So make sure you go in and download the report and save that to your computer. Overall market dynamics, 1-page snapshot, but here's what we're looking at so far for May. Interestingly enough, from April to May, our active inventory rose 27.2%, and we were up to 3,574 total available units for sale. New listings only went up by 8%, and we have to keep in mind that new listing inventory is down 26% from the same month 1 year ago. Now, again, we're experiencing interest rate gridlock, so I'm not expecting there to be a huge flurry of new listing activity that's going to carry us through June, July, and August. It's true, while inventory will go up, there will be more new listings. We won't see new listings to the same degree as what we've seen previously because we're in a higher interest rate environment. And so many people locked into the 2s and 3s that they don't want to move into a smaller house for more money. So a lot of people are just choosing to stay put. Pending transactions rose from April to May by about 16%. We had kind of a funky little blip. From March warmed up, April cooled off, May warmed up. And so we've kind of got this little V-shaped curve of activity that's been happening in our marketplace, where we ended up putting more units under contract in May. We were earlier saying that we thought that we might have peaked out in May. Looks like we've got more in March. It looks like we put more under contract in May, so that carried us through. We'll continue to see what's holding on for June, July, and August, but historically, June, July, and August starts to slow down. Sold transactions in the month of May were actually down 7.9% from the previous month, and that's a function of what went under contract back in April. And so again, we had a slower April, so there were fewer closings that happened in the month of May. Expired listings went up by 9.2% with 344, and our month supply of inventory, we rounded out at 1.3 months worth of inventory. And so again, keep in mind that historically, when that number is below 1, that means that we have more buyers in the market than homes to sell those folks. And that's when we see multiple offers, is when that number is below 1, so our multiple offers are starting to wear off. I'm oftentimes getting the question, Megan, how's the market? And my answer is always, it depends. And so I'll show you a heat map here in a couple seconds that breaks out into each different zip code what the month supply of inventory is, so you can see where we're more or less competitive, but it definitely depends on where you are. Now, overall,
Megan, really quickly, to your, because you kept talking about like March versus April versus May. I just wanted to highlight really quickly. So we actually saw the pop up in interest rates above 7% happen the first week of March. So you're going to have those buyers removing themselves from the activity, which is why April started to dip. Then in April, we actually saw our interest rates nationally go down to 6 1/8, 6 1/4. So that helped our May. But you guys remember, in May is when we saw the rates going, last week of May, we saw the rates going above 7% again. So stay busy, stay active. It could be a forecast that June is down a little bit based on the interest rates and the fact that we've seen the mortgage application numbers down, but really tight correlation to what we're seeing on the interest rates.
Definitely. Now, this graph shows historically how many active listings we have available for sale based off of data from 2013 through 2019. I've excluded the pandemic years. Those were exceptional years from 2020 through 2022. They don't make sense to include in a baseline analysis. So I went back from 2013 to 2019 and benchmarking that out, we would typically have about 5,200 detached homes available for sale, whereas we only have about 3,500. Also, pending transactions were down. So we're down by about 25% from what we would typically see in the month of May. And the month of May is typically our heaviest month for units going under contract, and it starts to dwindle from there on out. So if you've got sellers that are sitting on the sidelines deciding if they're going to sell this year or not, notice that our buyer pool really rapidly starts to deteriorate as we get past June, July, August, and September. with December being our slowest month with about 2,000 units, but overall we're down by about 25%. Here's month supply of inventory broken out by price range, and the only two price ranges that are left below 1 month worth of inventory are homes that are under $600,000 right now. So you're still likely to see those multiple offers for homes that are under $600,000 across Metro Denver. But 600 to 800 popped up to 1.2, 800 to a million was 1.4 months worth of inventory, 1 to 1.5 months of $1 to $1.5 million was 1.6 months of inventory. 1 to 2 million, 2.6, about 3 to 4 months worth of inventory here between 2 to 4 million. 4 to 5 million was at 6.6, and 5 million or more stretched out to 13 months of inventory. So this is my favorite map to refer to when people ask me how's the market, and I say, well, it depends. And so depending on what you're looking at is really going to dictate what's happening here in Metro Denver in terms of overall market velocity and how your home is going to sell. Again, it's really important that you guys are doing your due diligence up front. You're taking great photos, you're staging properties, you're making repairs on the properties, the updates that are appropriate for the property in order to sell them for top dollar, because buyers don't have money left over to come in and make renovations on properties right now. And so looking at all of this information, the way that you read this is our overall average for month supply of inventory. When I combined attached and detached residential in Metro Denver, we had 1.25 months worth of inventory. So if a zip code turns red, it means that it had less inventory than that. And if it turns blue, it indicates that it had more inventory than that. And so if it turns red, that means that you're below 1 month worth of inventory and you're likely to see multiple offers. However, if it turns blue or green, we're going to see that market cool and you're going to see more negotiating power in those particular markets. So areas that continue to remain hot are those inner landlocked ring suburbs that run around the inside edge of C470. I don't know if you can see my cursor or not, but hopefully you can. But right around here, as we get into the eastern edge of Denver and the western edge of Aurora, down into Greenwood Village and Centennial, north into Lone Tree and Greenwood Village. Highlands Ranch remains hot with about 0.5 to 0.6 months worth of inventory. Littleton is also very good with below 1 month worth of inventory. Looking out here into the northern parts of Lakewood, all below 1 month worth of inventory, up into our are also very hot, and along that I-25 corridor that runs north past 76 up to about 144th. Thornton was also hot with 0.7 months worth of inventory. However, cooler zones out here south of the airport, we've got 3.78 months worth of inventory, and this is our most saturated market right now across Metro Denver. Overall, 3.78 months worth of inventory isn't a whole heck of a lot, but it's significantly more than what you're going to be feeling if you're in those inner landlocked ring suburbs. Lodo 80202 came in at about 3 months worth of inventory. Conifer and Pine at 2.18. Down here into Elbert County, we're looking at about 2.84, and into Parker, we're sitting at about 1.5 to 1.9 months worth of inventory, as well as Sterling Ranch down here just to the west of Chatfield Reservoir at 1.86 months worth of inventory. Notice that in central Denver, we've got a slight cooling pattern that's happening here as well, with about 1.5 to 2 months worth of inventory. So we're seeing people that are leaving central Denver and they're moving to these inner landlocked ring suburbs where they're getting out of the city. Let's go ahead and pop ahead to the odds of selling. As we look at the odds of selling, we dropped by about 4.7% going from April into May for the overall odds of selling. I've always been telling you guys I'm a big fan of April transactions. I think that April is really the best month to list in. And so far that's rung true. The best week to list in so far this year was the week directly following Easter weekend. We've been watching the odds of selling slide ever so slightly ever since then. And so it's going to continue to slide as we get into the back half of the year. But now we're down to about a 59.5% odds of selling, which is still higher and better than what we've historically tracked for May at 58.2% odds of selling. We were at 59.5%, but notice here it continues to cool off as we get into June, July, August, and September. Then October through December, it roughly stabilizes. Yes.
You've got a question in the Q&A that is specifically perfect for the slide. Do we see a big difference between July, August, or September in terms of the best month for sellers to list between those three?
Yes, you want to get your listing to market as soon as you can, because we start to see the odds really taper off. And especially after Independence Day weekend, the odds of selling really starts to taper off by that. The difference between listing in May with 58.2% odds of selling, June at 55.1%, July at 52%, August at 50%, and September is notoriously our most difficult and challenging market to sell in, as kids are heading back to school at 47.8% odds of selling. Looking at it broken out into the heat map, again, highest and best odds of selling continue to be in those inner landlocked ring suburbs, cooler just south of the airport, cooler down into Parker and Elbert County, getting cooler as we get into Sterling Ranch and out into Conifer and Pine. Lodo, and notice Highlands has cooled off, as has some of the other Sunnyside and Regis neighborhoods that are just getting to the west of downtown there, going down I-70 down that corridor. We're going to skip ahead and we're going to talk a little bit about average days on market and median days on market. Average days on market for listings that closed in the month of May, which was meaning that they were likely under contract in April, dropped down to 21 average days on market. We were at 6 median days on market, meaning about half the homes were under contract in 6 days or fewer. For purchases that were under contract in 7 days or less, 56.4%. That was up 15.1% month over month. And again, that's a better indication of what was actually happening back in April than it was with closing in May. We're going to skip ahead finally to sold price ratios. Our average sales price came in 2.9% higher in May than it did in April, with a $783,000 average sales price. And the media has been talking a lot about how average home prices are falling when we look at the annual numbers, but month over month, those numbers are going up. And looking at this year over year, last month we were down 7%. Now we're down 2.3% from the same month 1 year ago. So we're getting back on track with where we were with appreciation. Keep in mind that prices ebb and flow as you go through the different seasons and as the supply and demand shift between each other. The way that you read this graph is this is showing month over month price changes on average across Metro Denver. So when the bar is above the zero mark, that means that prices are going up month over month. And when the bar is below the zero mark, that means that prices are going down month over month. And this is based off of closed transactions. So headed into June, for listings that were listed and went under contract in May are likely to close at 1.1% more than what they closed for in May. But notice if you close in July, August, and September, that your average home price falls about 5% from those 3 months going forward. So now is not the time to be super aggressive in your asking price, and you may find yourself having to go below some of the comps that just sold in your neighborhood in order to capture the appropriate set of buyers in your marketplace, because prices tend to fall as inventory begins to rise. And so keep that in mind. Last one that I wanted to show you is I do have a graph that talks about multiple offers and where we're seeing them most frequently. Again, in those red areas, it was 43.8% of all the homes sold for over asking price. Anything that turns red was more competitive, and anything that turns blue or green becomes less competitive overall in terms of what percentage of listings sold for over asking price. And it's kind of a shot in the dark as to how far over asking price goes. So I made a graph for you guys that shows on average, if it was in a multiple offer situation, how far over asking price would you have to go in order to win that deal? And what was amazing to me is the difference between the east side and the west side of I-25 as to how far over asking price you have to go. When you're over asking price on the east side of I-25, you're looking at about 2 to 4% over asking price, versus on the west side of I-25, with the exception of Candelas and Leiden Rock and a little portion of that southwest Denver territory, we're looking at 3 to 7% over asking price. So you are paying premium prices in order to live on the west side of I-25. We'll pause there for a second. Are there any questions that I should be answering before I move on to the next one?
Let me ask you 3 quick. And so just a reiteration, is March the very best time to list?
So I've been finding that it's April. That second weekend in April has been the best week to list in based on data from the last couple of years.
And then can you remind us where to find the showings per week, per area in the showing time reports?
Yes. So if you go into showing time, into reports, into target market analysis. There you can get the total number of showings by zip code and by price range. And from that, you can go in and run a search in the MLS for how many units went under contract. Divide that number of units that went under contract into the total number of showings, and that gives you shows to pending.
I think that that's fantastic. All right. In your opinion, if you can't get to market before Independence Day weekend, is it better to wait through the summer and list after Labor Day?
No, I would still list it in the summertime because there are fewer buyers in the market as we start to get back into the later part of the year. So I would wait. Independence Day falls on a Tuesday this year. And so that doesn't mean a 2-day weekend, a day at work, and then another day off. It means 4-day weekend. And so don't list over Independence Day weekend. Either get it to market the weekend before, which would be ideal, or the weekend after Independence Day weekend, but not Independence Day weekend this year.
No, 4-day weekend, people are out. What was the month-over-month price increase in May?
Let me pull that back up real quick.
Okay.
Where'd it go? So month over month, home prices went up from April to May by 2.9%.
0.9. Okay. What do you know about the Fort Collins market activity? Resources on where we can get more details.
Well, so in Iris, they have InfoSparks, just like we do in RE Colorado. I would encourage you to look at InfoSparks and those graphs in order to get an idea of what's happening in the Fort Collins market. But unfortunately, I don't have access to Iris data the same way that I do to RE Colorado data. So I can't track and trend Fort Collins.
Okay. Do we see a bump in October as compared to summer when it comes to people listing?
No, we don't. We really see the bulk of listing activity coming in from April, May, June, July, August, and September. And then it starts to taper off pretty drastically from there on out.
And then last question, thoughts on listing Father's Day weekend versus the weekend after?
So Father's Day weekend ends up taking about 10% out of the overall market in terms of sales velocity for purchase contracts. And so if you can, I would say the weekend before Father's Day, if you can. If you can't, then the weekend after probably, especially if you're in one of those higher price points. In the higher price points, they tend to be shaken a little bit more by those holiday weekends.
Sounds good. That's it.
All right, so let's hop into the weekly report super fast, and then we'll get on with Nicole's portion of the presentation in the second part. And so again, give me just a second while I get my screen all set up here. Slideshow from beginning. So this covers the week of May 31st through June 6th. I'm going to be doing a little bit of double duty here, trying to get through. We've got 2 weeks of information to go through. We have Memorial Weekend, which was down about 25% in terms of overall showing activity and purchase contracts. But then we popped back up, but not to the same degree. And again, here's your synopsis of what happened over the week so that you guys have that. And so again, the top headline here is market rebounds after Memorial Day, but not back to the same level as spring markets. Overall, as we start to look at our strategy sheets here building in, you can see that I've got blue creeping in here for our average daily active count, new listings coming on market, back on markets, expired transactions were up as well as withdrawn transactions. And so we're ending up starting to see that shift already in our marketplace. So we could already start to see some retraction in the market in terms of our average prices that we're going to be going for even as we get into the beginning of June. Overall, our average daily active count went up by 1% week over week. We had about 4,739 total units headed into last weekend, and new listings going from Memorial Weekend into this weekend increased by 53.8%. We saw 1,312 new listings making their way to market. So there's lots of new inventory out there. Now, not to be matched with that, pending transactions also went up from Memorial Weekend by 25.6% 6%, putting about 1,000 units under contract this last week, making our month supply of inventory about 1 month worth of inventory. Over Memorial Weekend, we ended up popping up to 1.3 months worth of inventory. So it was a great time to get your buyers out to go and show them those properties. But then it shot back down to about 1 month worth of inventory where we've been hanging out for the past 3 or 4 weeks or so. Looking at the odds of selling week over week, it went up by about 3.2% up to 61.6% odds of selling if you listed last weekend for the next 30-day period of time, which is still overall very good and it's high. It's beating what the average is for typical June months, which was around 58% odds of selling. So I'm pleased to see that number coming in as what we've expected it to. We're still very far from a market balance. Even though we've got more inventory making its way to market, I am not convinced that we're going to see major strides and tons of new inventory making its way to market. In order to offset the amount of demand right now to make that magical 6-month supply of inventory, we'd need to have about 27,500 active units available for sale. There were 13,990 total showings that were set last week, which increased over Memorial Weekend by about 26.9%, but it's still 10.4% fewer than the same week 1 year ago. That means that you should have been getting about 3 shows per property per week. So if you didn't get your 3 showings, that may be indication number 1 that you don't have enough bandwidth in order to get people through that house and get that property under contract. So you need to be getting at least 3 shows per property per week. Conversely, with those 14,000 total showings that were set last week and 1,000 units going under contract, that means that we're looking at about 13 showings to go under contract. So if you've had a total of 13 showings and no offers, maybe time to go through and make that price reduction. Median days on market over Memorial Weekend was sitting at 9 median days on market. So people really took that time off to go off and go camping, go to the pool, remember those we lost. And then it shot back down to 7 median days on market as we got into the very first weekend in June here in Metro Denver. 26.1% of what went under contract last week ended up making a price reduction, with 71.2% remaining unchanged. The average price reduction was about 5.1%, which is right on pace with where we should be for the month of June. Keep in mind that I do have this entire report broken out into $500,000 price segments for you so that you guys can go through and look at your particular price segment. But I think that takes up all the time that I have for today. And so I would like to, if there are no other questions left, we'll turn it over to Nicole a couple minutes early and give her some time to talk today. You're on mute.
Okay. Like, really, what? And then we just had one comment come in after Valerie said it's interesting. She was talking about the price growth because October seems to have a spike in price according to your graphs. So I don't know if that's just, yeah.
It's so minimal.
And it's coming off of the down months too. So it's not even like, we did get another question. What is the average list price to close price for all prices and units in the metro area?
So it was 99.9% based on closings, close to list or close to original. Close to list was 100.9% of the close to list price ratio. So that's based off of the last asking price. Close to original price ratio was 99% based off of closed transactions from the month of May.
The brain of a mathematician. I remember a lot of stuff, but no. All right, here we go. So guys, this is such a phenomenal time to do what we do. Like, we've got to keep going out there. As Megan was showing how April dipped from March to May, and we had this, and I like jumped in. I was like, oh my gosh, this is spot on with what the interest rates are doing. You know, yes, I get the fact that buyers are getting psyched out when they see a handle with a 7 in it. But ultimately, people move. Ultimately, people have babies, people get divorced, people graduate, and people move. Now, less people will move because they're locked in. Forget about the fact that they're locked in with a 3% interest rate. Interest rate gridlock is a thing, but ultimately, they're locked in with a monthly payment that is offsetting any inflationary action that's happening outside in the economy. So they're like, I'm not touching this. Like, this feels really real to me and I can hold on to it. And the rest of life is costing me more. So why would I go, as Megan always says, and it's appropriate, why would I go buy a smaller house for more money or really move at all? Because right now I'm not 100% sure where things are going to happen. So I'm just going to hold on to this house. So having the ability to have a conversation, I'm actually working on a couple of presentation slides that I'm going to show you guys next week. So we're going to have more tools next week. So make sure to join us again when Megan and I get together. And I'm going to show you some tools to say, what if I have a 3% interest rate, a ton of equity, maybe some consumer debt? So how do I pay off the consumer debt and move myself into a 6.5% interest rate on a more appropriate home, a home that I want to be in, and actually be able to pay that loan down faster and put myself into a position where I'm saving hundreds of thousands of dollars and an interest rate of 6.5 and not 3. So there are options for people who feel locked in because they have a 3% interest rate, so they don't want to leave that home. Yet I can show you, based on your current financial situation, that I can actually leapfrog you ahead towards retirement and put you into a 6.5% interest rate. So I'm going to show that next week. So make sure to join us, giving you the tools so that you can sit down with your clients and talk about options. Because ultimately, you being the resource and the advisor is the thing that's going to carry you through the rest of this year and into next year. I mean, think about the fact that May saw an uptick in sales. And if you're thinking, I didn't see an uptick in sales, well, then maybe that's because you weren't staying as active during the downturn in April. So are you consistently staying active and in front of your clients with information that we've been sharing with you? Megan and I put together pretty ad hoc, actually, and we put together a fantastic panel talking about the property tax changes and what that means to your clients and how you can communicate it and be the thought leader in front of them. And then at that meeting, we also talked about the fact that you can go out and also now talk about the fact that your home values are up. Are you underinsured? And does that put you at risk? As your expert in all things housing, I want to prepare you for that. And let's talk about that. And if you don't have an insurance agent you love, know and trust, I can refer you to somebody, right? It's starting that conversation. All of these are conversation starters. This conversation that we're going to talk about next week is another conversation starter. It's the opportunity to say, I know you're locked in at 3%, but what would it look like if we could remove all the other debt, put yourself in a position where you have more money working for you, maybe even buy a home and an investment, and now you've got a future you can count on instead of being locked in fear, giving up a 3% interest rate. It's not healthy. It's okay to say, I'm good, and this feels safe to me because of inflationary matters. It's another to say, I don't have any options. How do you break through that? Conversation starters. Okay, so done with my ramble. I get so excited because there's so many things to talk about. I'm going to share my screen, start the presentation. You're like, your slides aren't moving yet. No, I know. I haven't shared them yet. I am feeling pretty giddy because, I'm going up on stage here just a little bit. So I kind of get this way when I'm going up on
get
stage.
pumped.
Well, I'm just like, yeah. All right. Share screen. Let's do the thing. So slide deck, screen 2. All right. So we already talked about this. I think that's hilarious. I had not even, guys, come on. Sharknado, really? Somebody made a movie about that? All right. So let's talk about what's going on. So there's no dumb ideas, is really what that means. There's no dumb ideas. The only dumb ideas are the ones that you don't think about, that you don't execute on, or that you don't at least throw out there and explore. Right? All right. So here we go. Last week, we had jobs week. It was a big week. You and we didn't talk because Megan and I didn't do this. So last week was jobs week, 339,000 new jobs created, yet unemployment went up from 3.3 to 3.7. Made no sense. So really quickly, as a reminder, there are 2 surveys. One is the establishment survey, which does an evaluation on the number of businesses that are active, those that are new, birth rates, and those that are closed, death rates of businesses. And based on those businesses, how many people on average they employ, and that turns into how many jobs there are. That gave us the 339,000 new jobs. Then there's the household survey, where they literally pick up a phone and call households on the week of the 12th every single month. So a lot of it has to do with what's happening on the 12th on that week. And so that week for that survey was down 310,000 jobs. That's why we saw unemployment jump from 3.3 to 3.7. Now, really quickly, you got to know we're already seeing 2 quarters of negative GDP decline. And when unemployment jumps a 0.5%, which it didn't, it jumped 0.4, but when unemployment jumps from the bottom and jumps up a 0.5% or more, that's when we are officially in a recession. It is tried and true and 100%. Every single recession that we've ever had was announced, if you will, by this unemployment number going up, which is one of the reasons why Powell and the Federal Reserve Board are so hyper-focused on the jobs market and in seeing more unemployed persons, which is awful. You don't wish for that for anyone, but it is what it is. All right. What the other thing that came out of that report last week was that wages slowed and hours worked dropped. These are good for a softening labor market. I mean, we had a JOLTS report that actually went up, meaning there are more open job positions again, which made no sense to me, but that was a little disturbing. But then this came out showing that wages have slowed. They're still increasing, but they've slowed, and that hours worked dropped. The hours worked per week that dropped accounted for, if you put that in actual people, singular people, several 100,000 jobs lost just in the hours worked numbers. So this was really good. And of course, the stock market kind of celebrated that. In fact, the NASDAQ and the S&P 500 set 2023 highs, both of them doing exceptionally well. I mean, Apple scaled to an all-time peak, and investors were all thinking, okay, there it is. The wages have slowed down. We saw unemployment go up. The feds are going to pause. So this week, we walked into this week going, oh, can we just take a break? Like for a minute, can we not have rates go above 7? Can we just take a breather and have a calm week, a light economic week between the debt ceiling being resolved and the CPI number and the Fed's meeting next week? This was supposed to be a quiet week. It was anything but it wasn't domestic. This was global. So we actually had global events affecting our markets this week. So what created the volatility that we saw this week? Because we actually started to see prices going up again yesterday. Oil prices went up. You guys probably saw that. Saudi Arabia got really pissed off that America wasn't going to refill all of the reserve stock that it used. And they were like, well, if you're not going to ask for all this oil, then we're going to start to pull back on the oil that we're going to produce, increasing the price. So there. And so they did the thing, right? And so we're expecting that just in time for 4th of July holiday, we're going to see an increase in gas prices. Wheat also went up 4% as a Ukrainian dam got destroyed. All of those global effects affecting our domestic prices, gas going up, wheat and food going up. Then on Tuesday, we saw the Royal Bank of Australia jump up their Fed rate. Their central bank rate is what it's called. We call it a Fed rate. They call it a central bank rate. After skipping, they went ahead and raised their central bank rate. So that just happened on Tuesday. Australia did it. Then on Wednesday, Canada did it. After 4 months of pause, they said, whoa, economy still too strong. People are still spending, which you could say the same thing about America, that we need to keep tapping on the brakes. And so they raised their central bank rate, and they said, expect more to come. Meanwhile, I don't know if you heard, but 4 countries have come out in the last 24 hours saying that they are officially in a recession. So this is starting to happen, and it always is global, and we've already had 2 quarters of negative GDP decline. We're waiting for those, and of course, it's always announced much later. So the 10-year pushed above 3.8% last night. It was right below it at 3.79 when the market shut down. And then in the overnight, because the overnight is affected by global events, in the overnight, it went to 3.84. And that is just the continued increasing in interest rates. And at the same time, we had an increase in the probability that the feds are going to, in fact, raise the Fed rate next month. So this month, everybody is somewhat agreed that they're going to skip. It'd be a big surprise if they didn't. It's going to move the markets in a negative way. But right now we're expecting that they're going to skip. And then in July, a 52% probability that they're going to raise the rate. They're going to follow Australia and Canada. Our rates followed. They actually started to tip up. You can see it a little bit right there. They popped up right below 7% nationwide. Now, what happened this morning? All kinds of fun and volatility is happening. Like, your clients don't need to know all this, but it's really good for you to see what is impacting the interest rates. How can I best advise my clients beyond the fact that they just advising them that the time is right when the time is right. Like if it's the 7% interest rate and they're moving because their family exploded and they just had twins, then it's time to move. It doesn't matter if it's a 7% interest rate, but understanding your craft, being able to communicate when things are happening and how they're impacting our market, the way we saw interest rates impacting our sales from March to April and then back up in May, is really good if you can explain that and not go, I don't know, like the market's just moving so fast and you just need to do the thing, right? And that's kind of how that lands. But no, being able to kind of talk through that. So the rates did fall a little bit, but they're actually coming back down today, which is really good because this happened this morning. Jobless claims leapt. I love that word. It's a big, like they just, so this is the first time going on unemployment. It's the initial jobless claims. So you can be on unemployment, you can get off unemployment and go back onto unemployment. Every time you get back onto unemployment, that first week you are on unemployment, that's the initial jobless claims. That's the number. So initial jobless claims, if you can see it. So right here, we've been tracking the 4-week moving average, which is really what we're watching, and it's been pretty stable. And then here's the line right there. It leapt past the 4-week moving average, which if that continues, remember, we're at the 8th, they're going to count on the week of the 12th, and that's going to give us our unemployment number the first Friday of next month. So if this continues a couple more times, we're going to see that unemployment number then go further up from 3.7 and really push us into that recessionary period, which I am not complaining about. It is exactly what the housing market needs to have happen. So as we try to watch what interest rates are doing and even be able to tell our clients, is it worth floating? When is the best time to buy? When can you increase your affordability? What are interest rates doing? Typically outside of something that's happening globally, like, or the debt ceiling conversations, which are, or the bank failures. I mean, my goodness, we've had plenty of uncertainty. So to get us back towards certainty and to get us back into a rhythm of what really affects interest rates, typically inflation. So we're watching what happens with the CPI next week. Now, the headline number has dropped significantly. If you guys remember, we just saw last month, the headline CPI number dropped below 5. It hit 4.9. Fantastic news. That could even drop further to around 4.5 to 4.3 this next month. Would be great news. So that headline number is really good, but it's the core that the Fed is really watching. This core, when you remove gas and food, because we just talked about Saudi Arabia, decreasing supply, increasing prices, wheat because of a dam across the globe. All of those things are affecting food and oil outside of the control of the Fed. So the Fed is going to remove oil and gas and food and just look at the core inflation. And the core inflation is sticky. It dropped from 5.6 to 5.5 last month, not very much, but we're watching. So I wanted to actually put these numbers up here because I know that we were waiting for May 10th and yada, yada, but this is actually how it's calculated. So the 5.5 is calculated if I add up every single one of these monthly. So I'm looking at a rolling 12 months. So don't add up April because April's over here. April falls off when the new April comes in. But if I add every number from this 0.4 to 0.6, that's going to give me the 5.5. Now, the idea is it is expected that we're going to see a 0.4 again, a 0.46, and this 0.63 is going to drop off. And then next month, this 0.6 is going to drop off. July is not going to be good to us. We could actually see inflation either be stable or go up. And then August is going to be good to us because it's going to be a lower number. And then September is going to be good to us because this number will fall off and a lower number will take its place. It's a rolling 12 months. When that happens and we see those inflationary numbers drop, then we see interest rates drop, because mortgage interest rates are tied to a long-term bond, and inflation is the arch enemy of bonds, because inflation steals your purchasing power. If I'm on a fixed Social Security income and my cost of bread keeps going up every month, and I'm going to the grocery store with this paycheck or this Social Security check every single month, that basket is going to get a little lower and a little lower and a little lower in its volume every single month as the cost of everything goes up, because I can buy less. That's why inflation is the arch enemy of bonds. And that's why watching this core inflation is so key as these bigger numbers roll off. And then you already know when I'm looking at July numbers, it's a really low number. So we're probably not going to get a lower number than that. It's probably going to stay flat. So we're really not going to get a nice drop in rates that month. So watching this ahead of time is going to allow you to kind of expect what's going to happen in the direction of interest rates. The other thing, though, that's impacting our interest rates now is the spread. So there is a spread of risk between the 10-year Treasury and the 30-year. Historically, they ran at a 1.65% spread, or 165 bips, however you want to see that. So if I had a 10-year Treasury at 3%, that meant I had a 30-year fixed mortgage rate at 4.65. That was the relationship for a very long time. Now, there are times during financial instability, like during 2008, where that spread gets wider. We have been in that spread getting, look at how wide that is. That's a 3.2% spread. That is a massive spread. So that just dropped. If we had a little bit more financial stability, if we didn't have banks collapsing, if we didn't have a debt ceiling explosion conversation, strutting, peacocking that we had in Congress, if we didn't have all of the financial instability, that spread would not be 3.2, it'd be 3. Maybe it'd be 2.8 or 2.6. And we would have lower interest rates for no other reason than we had financial stability. So we're watching inflation and we're watching the spread. Financial stability, that could drop without anything else. We could get towards stability. We could have the same CPI number and we could see interest rates drop the moment we feel good about the economy that we've got. So we're watching that as well. So mortgage purchase applications dropped 1.7%. Not a massive surprise. We've been seeing a lot of instability in the interest rates, which is causing a lot of stress on home buyers, and some of them just want to pull back. Because of that, we're seeing in the mortgage space a 20% decline from last year, which had a 50% decline from the year before that. Guys, I'm going to implore you. Megan and I say this all the time. We do this to educate you, to be the best that you can be for your clients, to support them to get off the fence and into action, and we also want to see you in that action, right? Our goal in doing this education is to see you at the closing tables, to be your partner. We both want to be your partner. Mortgage production is down 20% after being down 50%. Do you know the kind of people that are out there right now trying to get your business, who either never have done a purchase because they were refi kings, didn't pay you any attention before, don't have the bandwidth, the knowledge, or the ability to educate, yet they want your business and they're willing to dial for dollars to get it? Guard yourself against those kinds of both lenders, title reps, whatever, and align yourself with a team that thick and thin, no matter what, we're doing the same thing week in, week out, because we love this industry. We love what we do. And then the other thing is the opt-outs are off the charts right now. The blast of phone calls, it is a federal law that the credit bureaus are allowed to share public information on anybody that pulls your credit. So make sure that you have all of your prospects opting out. We're talking to all of our clients as well, making sure to protect them. We'll have that in Agent Ignite this afternoon. All right, back to our regular programming. I got off my horse. So it's a supply issue, right? We know that. We talk about that all the time. You've got locked up supply, you've got low supply, the builders can't keep up, existing inventory is down. It's going to keep home prices. If I have one more conversation, I'm gonna have 1,000 more conversations. I know I am. But honestly, the conversation that we're gonna hit a bust, that prices are gonna drop, that the real estate market, when we hit this recession, the real estate market is going to implode and everybody's gonna lose their values. It's just not possible. We don't have enough inventory. Megan.
I just came off mute because we have to go into the it's not a bubble conversation. This is a supply and demand issue that we are currently faced with. And there's a set number of people that have to move every year because of birth, death, divorce, loss of a job, all of those things that are happening in people's lives that force them to have to buy or sell real estate. Right now is one of those years that's why people are choosing to move. And we're still seeing prices going up, even though we have significantly fewer buyers this year because we are so shallow on inventory. So far this year alone, average home prices have gone up between 7.5% to 8.5% just this year.
Right. Wow. Megan, you might have to eat your words. You said that we weren't going to see price appreciation.
Well, when we compare the entire year, that's going to be a different story compared to last year. But right now we're seeing prices go up.
I've got all my toes and all my fingers crossed. No, I'm just kidding. No, guys, even if you're putting 3% down, minimum down, and you squeak out a 1%, a 2% appreciation this year, even a 0.5% appreciation this year, even if it's slowly growing, you only put a small amount down. You get appreciation on the whole value. It's still a win. And you got principal reduction, and you're not paying somebody else's mortgage because you're not renting. So it doesn't ultimately matter. Jeremy Kane says this all the time. He goes, if you're renting, you're paying 100% interest rate. I've totally stolen that, and it's absolutely accurate. All right, let's keep going on this, because interestingly enough, exactly what Megan just said, FHFA just came out. Now this is dated. It's March, it's first quarter. I get that. We've already moved on. We're in June. But FHFA nationwide, look at this. They did the little dip. They lost some value. FHFA is Fannie Mae and Freddie Mac. So these are only conventional loans, mind you. They're not jumbo, they're not govy loans. These are only conventional loans that they're saying that based on the loans that they're doing, Fannie Mae and Freddie Mac, their values are actually starting to pick up again. And they've hit another all-time high in home values. And this was in as of March. We talked about the fact that we saw the
Nicole, if you can hear me, I think we might have just lost you, or I dropped my internet signal. We'll give just, oh, you cut out. You're cutting out.
All right, Megan, can you hear me now? All right, I was just like, I'm just going to sit still. All right. So here we go. All right, so FHFA.
You're cutting out again.
Another, oh no, okay, well, presentation might be short. All right, let's see. All right, can you hear me now?
I can, but it's real spotty.
Okay. All right. Well, Facebook is still recording my voice, so I'm going to just finish this up because this was near the end. And we'll just see how much of it comes through. Hopefully a lot of it. It's a little bit, we'll see. So just it has to come down. If you look at some of these price growths, if you prices to drop, you would have had to wait 25 years. Megan, can you hear me? Oh, there it is. Okay, I'm seeing the presentation. All right, so just because it goes up doesn't mean it has to go down. We saw massive price growth decades, and it took years to see any kind of price drop. In fact, 20 this grouping and over 10 years after 1970s. So that kind of price growth does not necessarily mean that prices are going to. We also have mass household formation. We have more formation than we do. I'm waiting to see if my, all right, guys. Can you hear me? Okay, I'm going to stop because since it skipped, finish us out. I got really close and it's almost 11 o'clock. Muted.
Well, thanks, guys. We really appreciate you following along. We'll be sure that you get a copy of our slide deck. Nicole posts hers in her Agent Ignite Facebook group, and I'll be sending mine out as soon as the video is done rendering. I'll get those slides out to you today so that you guys can use those to better advise your buyers and sellers. And we certainly hope that we're able to help you better advise your buyers and sellers, that they will end up at our closing tables. Please think of Nicole Ruth and Megan Aller for all of your servicing needs. We hope you guys have a great rest of your week and a great weekend. Thanks, guys. Bye-bye.
Bye.